Hello everyone, welcome to the Road to Retiring YouTube channel. I wanted to do a bit of a different video today. I wanted to show you my current investing method and sort of how I'm going about things at the moment. It'll be interesting to hear your guys' opinions on how you feel about it, if there's anything you change or whatnot, but I'm going to go over how I do things at the moment. And so let's just get started right away. So the first thing that I like to look for is on this ultimate stock valuation spreadsheet right here, and both access to this and another spreadsheet I'm going to show you later. You can have access to that on my Patreon in the description. Literally, you can choose how much you want to put in for that. That can be as little as $1, I think. So $1 a month, and you can have access to all this. It's nothing much. It's more of a tip rather than an actual payment. But on here, so the first thing I like to do before I go into sort of any stocks, first thing I look at is on this metrics page. I like all of these to be green on average. This is basically my risk management page, and for each of these that fail, I would usually increase the margin of safety. But for all three of these that pass, they get added to a list which I keep track of because they're the ones that the stocks I'm really confident in. So this is a sort of risk management page. The first thing I like to look at is a company's moat. I want to see that it has a strong ability to maintain its competitive advantages. I believe good growth in equity, EPS, operational cash flow, and in revenue show that it has that moat to a degree. But that is the first thing I like to look at, and this is all automated really quick. I was looking at Keys earlier because they had a really bad earnings report today, so they actually dropped massively in price, and because of that I wanted to readjust my own valuation for them. You can see that down 13.5% today. That's a really nasty drop after their earnings report. But yeah, back to the stock valuation. Let's do Google, for example, as it's just a fan favorite over on this channel. If we do that, you can see all of these are beautifully green. These, unfortunately, I don't have updating automatically, so I will have to input these yellow fields manually myself and this return on invested capital, but I like to see that about above 10%. But yeah, if we see an average over 10% in that compound annual growth rate across the four metrics here, then I consider that to show that they have a good, strong, durable moat. And as you can see for Google, just every single thing's gone green. It's beautiful to see. Great growth since 2015 in all of the metrics, and that's a 16.35% total average annual compound growth rate in those four metrics. So that shows me reduced risk to begin with, but then I want to see that their management is dealing with their funds well and is investing funds well. So I look at their return on invested capital. For this, I like to see that a company is sitting above that 10% average return on invested capital over, say, the past 7 years. Again, something similar. So we're going to head over to financials here for Google, statistics and annual, and look at their return on invested capital. So as I said, I like to see it above 10% on average, and for Google, as you can see, it's 15% here, 8%, 18, 17, all the way up to currently, right now, at 21%. Obviously, other than this one, 8.46, on average is sitting way above that 10% mark I like to look for, and currently it's over double that, which is really, really nice to see. So again, I consider this to show that their management is dealing with their funds well and investing it in the right places. So if we would put that at the current amount, obviously it's going to be green. Anything above 10% is green. It's just something I like to, it's just there for me to confirm. I need to check this before I say this is my metrics on the bottom right here. So this is just something I like to check. And yeah, on average, probably way above 50. I'm not going to work it out because I said anything above 10 I'm happy with, and the average is very clearly, obviously, above 10. It's probably somewhere around that 18, 19 mark would be my guess. But obviously way above that 10 mark. So that's obviously great. And Google, I obviously know this is already going to go green because it's one that I've put some investments into already, and it's a position I'm quite frequently adding to at the moment because I think it's quite a nice valuation. But let's just do this for the sake of it. Long-term debt and the free cash flow. I like to see that the company is not going to be in any imminent financial trouble, and I think that this shows this. They're able to pay off any long-term debt they have within 3 years, which is why I have the 3 times free cash flow here, and I consider that to be a good sign that they're not going to be in any imminent massive financial trouble. So that's another thing I like to check before going into any investments I make. So let's check what the case is for Google. These numbers aren't Google's, these are any random numbers from probably these or whoever I was just looking at. But Google statements, we're going to look at the long-term debt first. See they're currently Q4 at 27.2 billion in long-term debt, so that's 27,200. And for free cash flow, they're currently sitting at 60 billion over the trailing 12 months. And you want to check that that's not just a one-off. You want to check annually that they'd be pretty comfortable with how much they have. And as you can see, over all of these years, even from 2016, within 3 years, they would have been able to pay off that 27 billion in long-term debt. So again, put it at 60 billion, but that's more than comfortable. And that to me shows that Google it meets a lot of metrics that I like to check before investing in something. And in this case, I think that they're really strong signs. That's my risk management. They meet all of these and everything goes green here on return on invested capital, the 3 times free cash flow over long-term debt, and the total averages. All 3 of these go green, then that means that I feel comfortable with a 10% margin of safety instead of maybe a higher 20, 25%. If it failed on all 3 of these, I'd probably increase it quite a lot. If it fails on 2, then maybe only increase it 20, 25, and it just fails on 1 by a little bit, then maybe 15, but you obviously have to manage that yourself. So that's the first part. I like to, any stocks that meet these, that turn all of these green, I put them into this sheet, the metric meters sheet, and you can see Google's right there. And then obviously I've got all my buy prices here, all the dates here. Again, if you want access to this spreadsheet to have a look at all of my buy prices or stocks, you can see all the dates where I've updated these values. If you want access to this, it again is in my Patreon in the link below. So I would add Google here, and then I've got to calculate my price. Obviously this isn't the price right now, this was on the 13th of February. But let's calculate what the price I think for it right now is. Automated, head over to this sheet. First of all, we're going to put Google in here just to see what comes up. The fair value straight away on here is coming in at 88, but as you can see, coming in at 14 for the cash flow, so something's clearly not quite right with this. So I always advise, if you are going to use this sheet, go into the manual input. All of these yellow fields, make sure you're putting these in yourself and not just using the ones that are in the automated sheet. Okay, I found what was wrong in the cash flow, and that is now all fixed. So that is what the actual automated sheet would output straight away. And as you can see, the outlook is really good, but obviously we need to update some of these numbers in the manual input. Let's go back to the manual input sheet. These are all currently the automated values, but we need to make sure that we're getting an accurate representation of our prediction for 2028. So right here, the earnings growth set at 11.63% from the automated one. The reason I have it set like this is because we have a 5-year estimate at 15.5% from the analysts, but typically analysts are about 100% too ambitious with their estimates, and they actually come in around 100% too high on average. However, we also use this realistic growth rate calculation. The reason we use this is to have a look to see if that analyst expectation is actually realistic, and this is calculated based on quite a long calculation, but it's to do with all of the fields you see here. It takes in their common shares outstanding, their EPS, their depreciation, their shareholder equity, and their long-term debt, and basing it off of that, I'll show you the calculation here. If we go to realistic, it was on here. Go to determine a realistic growth rate, and it sits right here under, where is it? Realistic growth rate. How do we fix this? We take the long-term debt and shareholders equity before calculating the return, and we can use depreciation and amortization expenses, and we use this all together. The formula, as you can see, looks like this, and this is how we can use it to sort of judge if the analyst growth rate is far too ambitious or if it's actually all right. So that's what we're using here for the realistic growth rate, and because of that, I'm going halfway between the 5-year estimate, because I'm still not 100% confident in it, and the half analyst growth rate. But as the realistic growth rate is higher, then say this was 10%, then we would reduce this earnings growth rate even further between those two values. So this is the average of the 2 lowest values that you see here. Now at 11.63%, let's have a look at what Google's earnings outlook is. As we say, 15% is what the analysts estimate. We're going from 5.16 in 2023 to $8.39 in earnings per share in 2026 here. As you can see, we're undershooting it quite a bit, and the value's still coming out quite nicely right now. But we'll have to compare this to the price over earnings here. So with the price over earnings, this is currently, we're using a 24 price over earnings value, as that's the average of the lowest four here. Again, just a slightly conservative estimate to put into the automated sheet and see if the value comes out nice straight away. And if it does, then we can do a bit more research. So what can we expect for the price to earnings to be in 2028? Well, you see it averaged out at around 28.3 over the last 5 years. But during that time, the earnings had a growth rate of 18.9%. Now that's quite a considerable growth rate, and I just want to bring over another tab here. Let's look at Google's sector. You can see that there's a 14 average PE here and a 16.69 forward PE for the average in their sector. So the Google one is a little bit high, but people are happy to pay a premium for the Google stock because it is such a well-known stock, and it obviously has great outlooks in terms of earnings, in terms of its moat. Everything, when you're looking at the historic growth of the stock, is really impressive. So people are happy to pay a bit of a premium for the Google stock. So if we were to consider that it was sitting at a 28% growth rate, whilst the, or 28% price over earnings, sorry, whilst the earnings growth was about 18.9, then we were basing that off of an 11% growth rate. I think we would bring this down a bit, maybe to around that 20 mark, maybe even a little lower, around 18, because you want to make sure you're a bit conservative with your estimate here. Now, what this is doing is this is taking 9.5% discount rate. As you can see, that's updated the PE ratio fair value to 98.54. This discount rate at 9.5% is after we calculate this value, which is 2028 value, using $18 as the price over earnings and with an 11.63% growth rate. Whilst we calculate that 2028 value, we then use this 9.5% discount rate because we're looking for a 9.5% return on our investment each year. We want that 9.5% compound annual growth rate on our investment. But then there's also the additional 10% margin on safety on top of that. And then if, after applying that 9.5% discount rate and that 10% margin of safety, if the 2023 value then still sits above the current, below the fair value, if that fair value then falls above the market price, like it does here, as you can see, 7% in green, that is when you would then consider purchasing the stock, or at least that's what I do. However, that's just price over earnings. I'd like to look at the operational cash flow growth rate and the sales as well. However, this is a little bit more tricky, especially with sales. Once a company is mature, the price over sales tends not to be as important. The price over sales is a lot more important to look at whilst the company's in that growth stage. Maybe whilst it's not become profitable yet, that's when you really want to focus using on that. But as you can see, estimates here have it going from 299 billion to 400 billion in 2026. So if we were to match those growth rates at 299 billion to 400 billion in 2026, you see this 11% slightly too high, so we're going to bring that down a bit, maybe to 10%, just below 10.5, brings us to 403 billion in 2026. Close enough to that 407 billion. We can go into more detail, but this is more showing you my valuation model rather than doing a Googl valuation in itself. So now we've done that, then also would like to change the price over sales. This price over sales multiple, again, this is just the average of the lowest four in the previous 6 years. The average in their sector is going to be way lower, as you can see, 1.3. I wouldn't consider that massively important, but maybe I would bring it down a little bit, as 5 is quite high, and you don't want the price over sales ratio fair value to be offsetting your price over earnings fair value and your price over cash flow fair value by too much, because, as I say, it's not overly important once a company has become profitable. You want to be using this more for companies that are in that really early growth stage. I'm going to bring that down to maybe 4 mark. You can offset it a bit, 4.2. You see that's going to bring it to 90. That's probably much more realistic or average, but as I say, the price over sales isn't overly important. You want to focus on this price over earnings and the price over cash flow one more for a company like Google. So cash flow to 91,000 here. Let's just check if that is accurate. So cash flow 91,500 over the trailing 12 months. So yeah, more than happy with that. And this price over operating cash flow, 15.98 is the average of the lowest 4 values in the previous 6 years. Now that seems fairly fair enough, but if you look at the sector average, it's actually really low for Google, sitting at around 7.8 or 9.4. But also the Google 5-year average is at 18-17. So again, people are happy to pay a premium for a stock like Google, so you can't just go off the sector median. It's a better stock than most of those in that sector, so people are happy to pay a premium for it. But at 7.8, 9.4, you might want to bring it down a little bit, something more realistic, maybe around the 14 mark. That would bring it to a $103 valuation. Now obviously you can update all of these things. If you don't agree with any of these values I have any of the yellow values can be updated and changed, and especially the price over earnings and the growth rate. So any multiples and growth rates, that's going to be where they're the real deciders for your fair value in 2028. But after all of that, you can see that the average 2028 value from those 3 comes in at $170 an hour, and the average fair value is at $97.34. And so after that, I would then be happy to buy Google stock below that price of $97.34, and that would bring you, if it did hit this value in 2028, a compound annual growth rate of 13.2% from the current value right now. So that's all that in a nutshell. Once I have that value for Google, I would then go to this metric meters and I will update the price. So you can see my buy price in 13th of February was $96. This is now $97.34, so it's not moved much. Probably very similar calculations. But $97.34, that'll be my new buy price, and I'll update the date to the 22nd of February. Now, at that point, I can come back to this spreadsheet, keep looking at it, and whenever anything goes green, I like to sort by the percentage difference. You see Merck's at minus 4.81%, so it's a little bit too high right now. If that goes green, I wouldn't advise buying it straight away, but you can then know, oh, it's in my green, let me go back into my calculations, let me calculate it again now, check that that value seems right, and then at that point, it might be a good time to buy. So that's how I keep track of all of these stocks that I'm interested in, and if they go into that green value, I'll look to potentially buy them and do a calculation again. That's my investment strategy in as quick as a nutshell as I can. I hope that this is useful for some of you, and let me know if there's anything you would change about it.